Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be analyzing LyondellBasell Industries stock, ticker LYB. I'm not sure if I pronounced that right. I've had a lot of requests for this one, so I'm finally getting around to it. If you have a request you'd like me to take a look at, put it down in the comments, and I'll get it on the chalkboard behind me. Eventually, I will make a video for you. As always, this is not individual investing advice. This is just how I analyze stocks. So let's just get right into this one. So I have this, if you watch any of my other videos, I do have this ticker in my spreadsheet, but I don't really have a buy price on it yet. And probably the reason for that is I have the fast graph here kind of maxed out, and we only have data going back to 2011. And so the first thing, other than looking at the earnings cyclicality, well, let's look at that first. We see that earnings declined during COVID and started to decline a little bit before that. And they declined more than 50%. So that would generally make me think it could be a cyclical business. But we also have this huge recovery, and now we have this other decline, which also looks like it could have cyclicality involved with it. But the problem is the pandemic screwed up like a lot of things. So if this was the only data that I had, I wouldn't immediately draw a conclusion that the business is cyclical when we aren't having a pandemic and a boom bust after the pandemic. But what does lead me to assume that, because we don't have data from the Great Recession, is if I look at their sub-industry of commodity chemicals, those are basically always cyclical. So if that makes me, I would start with, unless I saw evidence to the contrary, like I had 20 years of data, they maybe were just a little bit cyclical during the Great Recession, then I would change my mind. But I can't even think of a commodity chemical company that I've come across that isn't basically a deep cyclical business or very close to it. So I pretty much would treat anything that has in this industry as cyclical. Okay, so now what that means is, so usually when I get questions from a lot of people about the same stock, and I look at it on the fast graph, and it has a PE of 11. So when you can consider that the S&P 500 is in the low 20s PE or something like that now, then 11 is like half that, so it looks cheap. Also, notably, this isn't an 11 PE like back here when earnings are at this super cyclical peak. Back then, the PE was actually like a 5, right? So that would be when you would worry about the cyclicality of earnings just falling off a cliff. If we go back to 2018, we can see at the peak, again, we're down at like 7. We're not at 11, right? Because earnings hadn't fallen yet. Now, when we go back to kind of this era, coming out of COVID, we get down to kind of where we are now. So because earnings have come down, now FastGraph uses blended earnings, so it will look forward a little bit and backward a little bit. Let me see if I can, what the actual current is. I'll just use my calculator here. So we have a $72 stock price and $6.60 worth of earnings expected to close this year. Yeah, that's at 11 actually. So it's looking kind of right where it is right now. So earnings have already fallen below even pre-pandemic levels. So we have some reason to believe that, you know, this PE might be kind of accurate, right? In terms of how PEs are used. Even though it's cyclical, earnings have already fallen a lot. So it might be a decent read on, you know, the value of the stock / business. Now the issue that I have here is, one, we don't know. I mean, we don't know how cyclical this business really is. Maybe these earnings go negative, in which case they could still fall a lot more. I really don't know what they're going to do. We don't have data on that. If we look back to 2010, I mean, they were pretty low. So it's possible they get really low, even lower than where they are now. So we shouldn't rule that out, first of all. This down cycle hasn't ended yet. Even though analysts are saying this, they kind of always say that. They always think that earnings are going to recover, and then they don't. So eventually analysts will be right and earnings will recover. But if you went back and looked at in time, they would have probably said that the last 2 years too and would have been wrong. So I would ignore those for now. And the one thing I would point out here is if you look at the difference between the market cap and the total enterprise value down here, okay, it's about the total enterprise value is about 73% higher than the market cap. So they probably have some kind of debt or other obligations that are involved here, and that, along with cyclicality, probably it helps explain why they have such a low PE all the time. So when you have even moderate cyclicality and you have kind of debt obligations, it means you probably have fixed overhead costs along with potential debt payments or other obligations or whatever. And so when these earnings fall like this, the risks get higher and higher. Also, when interest rates rise, they do as well. So the market kind of knows that and takes it into consideration, and that's why it kind of perpetually trades at this low PE. Let's see what the returns have been like. So it's returned 100% over the past, I don't know how many years that is. Well, it's almost a 10% CAGR. If you bought it right back in 2011 through 2025, so 14 or 15 years. So from kind of beginning to this kind of trough we're in now, still produced like decent returns. But if you went from 10 years ago to 2014 to now, you would be negative. So I think I saw somebody mention the dividend on this. So this could be another reason people are, I want the yield. No. The white line is what I want. Okay, so it looks like they gave some kind of special dividend for when they had the kind of windfall profits from the COVID boom or post-COVID boom. And now we're looking at, let's see, okay, 7% yield. So I'm sure some people are looking at this and wondering about the 7% yield. I wouldn't buy this for the dividend, and I actually probably my instinct here would be to, if earnings get worse, to wait and see if they cut the dividend, and then that might be a time, and then the stock price will probably spike down, and then that would be kind of the time to come in. That would be my personal inclination because I don't really care about the dividend. With cyclical stocks, you usually want to buy them during down cycles and then sell them once they've recouped their old high, right? So the dividend doesn't really, play much of a role. Now, that said, there are a couple exceptions that people have been able to work out over the past 20 years, since the Great Recession, basically. If you bought Caterpillar or Deere back in like 2009, you could have bought and held those, and you would just be collecting like a bunch of fat dividend checks now, basically. So it's not impossible every now and then for one of these big industrial companies to that you can buy them when the dividends are kind of accidentally high and then do fantastic and not really have to sell them. But it's pretty risky, and I think Caterpillar and Deere have gotten lucky, and that's not the strategy I would use over the long term with cyclicals. So that would be, but it doesn't mean that LYB couldn't pull it off, right? Especially if we get a kind of shallow decline like we saw in 2018, going into 2019, which I'll look at here in just a second. So my instinct here, let's get rid of the dividends, would be to look at the historical stock price, even though we don't have a lot of it. So I'm going to kind of break everything down here just so we can see the stock price. And like I said, I would prefer to have more data with a deep cyclical, but if a person's interested in maybe buying this is how I would go about doing it. This was an industrial peak, right? These guys make like plastic-based things like packaging and bottles and rubber and all kinds of stuff like that. This is tied to the industrial economy and to some sense the goods economy as well. So that all peaked about January 2018, and it had a down cycle, but it wasn't a full recessionary down cycle. So this is actually, and it wasn't the COVID that went all the way down to the bottom here, right? So for a shallow, non-Great Recession type, non-COVID type downturn, this is a good place to look, a good period to look to get a guide on what you might expect in the future, which is what we have going so far, I think. And so they fell about 45% off their highs there. So for me, I would say I don't buy cyclicals unless they're at least 50% off their high. So I would probably aim, if you're feeling like this is one you want to take a chance on, I wouldn't buy until it was at least 50% off its high. So let me give you that number since I don't have it in my spreadsheet. So we're looking at 117 basically. You're looking at about, call it $59 a share. We're at 72 now, so there will still be a ways to go. Now, if we want to use COVID as kind of maybe what a better recession would look like, at least in terms of the drawdown, then I want to say it fell about 65%. So it fell about 65% from that 2018 peak to when we did have a official recession, even though it was a weird one. That is 65% off its highs. So I would be more interested at that point, I think, personally, especially if they fell 50%, they cut their dividend, people were all complaining about it. I would probably be inclined to come in at that point. And then you could expect to get a 100% return within 5 years would be the goal. Now, if you come in lower, or maybe you add another position, I probably wouldn't buy this one more than twice. I would aim for that 65% level because, look, I mean, you can even actually see it if I go back. So if you bought at 42 and you sold, let's say, we had a super quick recovery that time, but let's say it took a couple years. So yeah, if you held it a little over 2 years, you could have gotten 172% return. So getting at that lower level, you're looking at like a 150% to maybe 200% return. And that's really good. You know, it'll be scary when you go to try to buy it that low because everything will be horribly negative. People will be saying they're going bankrupt. There'll be panic. But that's how you get those big returns, potential big returns. And if you bought part of it at 50% on the way down, and then you bought another position at 65%, then you're going to be getting somewhere, probably around 150% return on average. And if you can, so you could wait 5 years and still get great returns if it takes 5 years for the stock and the cycle to eventually recover. I take small position sizes precisely because these stocks can be very volatile. They can fall deeply, and sometimes they can fail, right? I mean, if the wrong things happen at the same time, they can fail or take a very long time to recover, which is just about as bad as failing. So that would be the levels that I would aim at if you're interested in it. Personally, I would be more inclined to buy if they cut the dividend, because that'll make it easier for them to recover. When they're paying out 7%, that makes it takes the recoveries longer. And the longer recoveries go, I would much rather make a 100% return during a quick recovery in like 2 years than wait for them to pay a dividend out over 5-10 years or something like that. That's just my preference for cyclical businesses. But you can get lucky, like with Caterpillar and Deere, if you buy them cheap enough. But you can see there wasn't really much growth. Once they had this initial growth coming out of the last downturn, I'll pick a spot that's kind of neutral here, like in 2014. From 2014 until 2024, you have 10 years. It returned 5% a year. Inflation probably averaged 3% a year over that time period. So you're getting a 2% real return for it over the course of a decade. That's with the dividend, right? So the real money isn't made from the dividend. It's made from this rise from, say, this bottom down here up until this area here where you could have made 300%, right? That's my thinking on it, and I can kind of illustrate it with this chart. Okay, if you have any more requests, put them down in the comments. If you enjoyed this, if you found it useful, hit the like and subscribe button. I have a free tier over on Patreon. Make sure to check that out. I also have a 25% off affiliate link for Fast Graphs down in the description, and they have free trials, so you can just go check it out, see if it's for you. And I'll see everybody later.